Welcome to the Pulse Check podcast. Yves Roesti, CEO and Managing Partner of Synpulse. Great to have you with us today.
Thanks, Solomon. Great to be here. And I just noticed that my dress code is completely out of whack with yours. I was told actually it's a dress down session, but I'm happy you went with red. I went with blue, so I think we're good to go.
It's a good match overall. It gives the two colors. And we're actually in Singapore, even though I'm Hong Kong based. So I'm very happy to be here and seeing you today. And as always, we start with a bit of a get to know you, get to know the guest on the podcast. So tell me, what is something that defines who you are, that makes you you?
Something that is probably a bit less well known and probably opposite to perception. I'm a minimalist person. That means I like simplicity in my life. So typically when I buy something, I also purge something else. There's the concept of the 100 items person. And I would say maybe for me it's a bit more than 100 items, but that's the concept, quite opposite of my wife. And then the second thing, and there we are both involved, I take care of the philanthropic development within the Synpulse partnership. And I take big passion and pride in working with grassroots initiative with very underdeveloped and underprivileged kids. And I believe education is everything in order to grow into a successful life. So, as you know, with a partner organization, we build schools. So already 5 schools built. The latest one was just finished now, and I'm looking forward to the opening ceremony that we normally also go there physically. And you've been a donor previously, and it's just a great project that has so much sustainability.
Yeah, I really love that. I think as consultants, we always want to also give back and educate. And it starts with the education as a kid. And I've seen some of the great pictures. I haven't been able to go to visit some of the schools myself yet. I would have to do that. But seeing the pictures, it's just amazing. Brings me a bit also into the topic of today. I wonder, it's for you, of course, you have your network, your relationship, you know where to find these projects to support. But for the mass affluent that may also want to put some money into good work, charities and so on, I do see that it's much more difficult. There's a bit of a hurdle to find out. Of course, there's lots of charities, but sometimes you don't know exactly where the money is going. And there was one project in Hong Kong we supported called Socially Responsible. I quite like what they are doing. We helped them to build an app where you can choose different charities of, okay, I want to put $50 into this charity and so on. And the good thing is you can then immediately get the tax receipts and everything. So all the documentation is also taken care of. But it's something that is really still a bit inaccessible, I believe, for the mass. So what do you think needs to happen in terms of, in general, wealth towards the mass, be it philanthropy, but also other areas that don't seem as accessible to the mass?
Yeah, good question. I mean, building schools is possible from $200 onwards. So I'm happy to give the contact. It's childstream.org where people can donate. But you're right. The proliferation of wealth to the affluent segment is there's quite a gap when it comes to this. And if we take one step back and we look at how that segment is evolving, especially for APAC, we discover that it has been growing for 10% per annum for over actually a decade, and it's prone to grow further, and if not accelerate. What's interesting is the needs that are coming out of that growth, right? And I would maybe compare Singapore and Hong Kong that have early sort of embraced the private banking practices and have a very established industry in the meantime, where they have the full, let's say, product shelf available to the high net worth individuals. So at least the product set is available. But this is in stark contrast towards the emerging markets, where also from a regulatory point of view, the product set is extremely limited. So much so that you have to actually, if you want to have exposure to international private banking, you have to go offshore and open an offshore account, onshore in Singapore and Hong Kong, for example. And of course, the regulatory framework is evolving, but case in point, let's say a domestic investor in Thailand or in Indonesia, they have to find feeder or wrapper fund structures in order to gain access to certain products. Locally, it's just government bonds, funds, and there's no speak of portfolio loans, etc. So that will take some time to catch up. But then closer to home, here in Singapore, I also believe there's a big gap when it comes to serving the affluent segment. We both have gone through that segment, so I think it's mainly set up at the moment with very high margin products that, let's say, the incumbent banks distribute through traditional channels. That are, have high subscription commissions and are actually one size fits all, basically. There's an opportunity, right, to automate the advisory for that affluent segment. On the lower end, I think things have evolved through the fintech sector. So there's quite a few robo-advisors. That's an asset management strategy based on let's say, ETF-based model portfolio, quite unspectacular, but, there the entry hurdle is very low, which is great. But that middle segment, before you then hit that sophisticated investor hurdle, that is largely underserved, I would say, with solution today. And maybe just one additional comment on how Hong Kong and Singapore interprets that sophistication level. What's happening is, from a regulatory framework, there's the flag, the distinction of accredited investor, AI, in Singapore, or professional investor, PI, in Hong Kong. And roughly what that means is you have to earn more than $300,000 per year, or a net worth of investable assets of $1 million. And so beyond that, you have access to more sophisticated products, and below that, things get very complicated, and the product shelf is very, very small. And so that's also how the industry has then set up, right, based on that. So that's not easy to solve, coming from a regulatory point of view, in terms of investor protection and so on. And that's a formidable challenge, I would also say, on how to build an advisory model that takes that into consideration.
Yeah, I think coming back to that, I mean, while, yes, that separation is clearly guided also by the regulator, but on top of that, many banks see, of course, the cost to serve for the ones that may reach that threshold, but are not yet the ultra high net worth individuals with 20 plus million US dollars. And for them, it's, of course, they don't want to tailor the services as much as the costs are high. So not only for the lower mass, but even also for the high net worth, it's sometimes more challenging to get really the full service quality. And you mentioned before, of course, there's the also digital adoption. There is the next generation of high net worth individuals that are also more used to use mobile, that may also accept that they do not have a monthly conversation with their relationship manager, but but at least also get more ideas shared through online channel. Why is that adoption also rather slow in terms of banking adopting the digital channels towards that segment? And what would you see banks probably need to go for to also be able to lower that cost to serve?
It might be the only way you can lower the cost to serve is by automating your advisory, right? Basically building an advisory at scale model for the various segments. Now, in order to automate the advisory, which is sort of your channel through either directly or maybe through a hybrid, meaning a mix between an assisted, maybe relationship manager based or maybe call center based channel, you have to ensure that the backend is fully digitized. Because without a digitized backend and an efficient backend, you will never be able to achieve that at scale. This will just not happen. And many banks are struggling with that. Of course, it then compounds with the aforementioned suitability rules, right? But also those can be implemented if you have a proper digitized backend. And that's where we are investing in with our Wealth as a Service proposition, where we try to bring an industrial platform, a fully fledged custody platform to wealth players, and bring that out as a subscription, basically. Because the idea is, talking about cost, let's say a small wealth player with $1 billion dollar assets under management should not pay more than 10 basis points for their platform. And just to put that into comparison, of course, it then also scales on the top end, but to put into comparison, the average revenue margin that the industry is making, that's across all wealth products, is actually around 90 basis points, so just shy of a percentage. And so we believe that with that delta, there is still room for a healthy margin to the business. And by providing this, of course, with modern cloud architectures and the TCOs, the total cost of ownership benefits that we have out of the hyperscaler environment, this should make for a very compelling case, where then also the wealth manager can focus on exactly what we wanted to achieve, the advisory proposition, and also the client engagement, and the front office, right? Relationship manager and the channels, basically. So that thing that they're really where they can differentiate, not the back end where things need to be efficient and industrial.
And I think the good news is that following the regulators in Singapore, Hong Kong, but now also just recently Taiwan, really the market is pushing towards that, and regulators are recommending also the basically cloud platform providers to really push and set up the infrastructure accordingly, because this also gives the advantage of launching new products and services towards clients much faster than in the traditional monolithical way of how platforms are built. So on that note, I would love to discuss a bit how this will evolve now. What's really next in Wealth as a Service? What can we expect in maybe the foreseeable future?
Yeah, so I mean, Wealth as a Service by right is a SaaS proposition. Of course, there's still the operating model that sits behind. And I remember a few years back, we wrote that famous, or maybe not famous, but that publication where we looked at the evolution of ops costs and how this can be harnessed. And just to summarize here, I think we came to the conclusion that level 1 was back in the 90s when there was offshoring, can save 30% plus on the cost side. Of course, you have a few other things you're going to have to deal with. But then that's level 1, right? Level 2 was then a sophisticated platform that allows you to build straight through processed transactions with minimal interaction. Maybe you can combine that also with an offshoring, so you have another 30% of costs that you can save. And then we said level 3 was actually potentially even outsourcing the operating model to a professional third party. And I always like the analogies from other industries. And if we take, for example, the car industry, and I know you drive a Tesla, so maybe the example will be different. But Honda and Bosch have the market leadership on spark plugs. But if you drive your BMW, you will not notice this, right? For you, that's still the brand itself. Maybe for your Tesla will be the BYD batteries, but you understand, right, what the idea is. So it's vertically specialized players that do this really, really well at the cost and at the level of quality that nobody else can actually, or very few can compete, right? And so putting this back into banking and wealth management, we've seen examples of these so-called BPO providers emerge and helping to make this operating model more lean. And now with the emergence of course, machine learning, right? You can even, for the manual decisions that are still needed on a 99% STP rate, or let's say for more complex processes such as letter of credits or Lombard loan evaluations, such models would help to automate further, right? So that's going to be very exciting as a next step. So that I would say number 1 in terms of operating model evolution. The other thing we're seeing in the market quite a lot now is many have invested into the digital backend, and they're now looking at portfolio risk engines. And this typically serves 2 purposes. It will help the institution to optimize the risk and return profile that you're interested as an investor. That for the minimal risk, you can get most return based on your risk appetite and risk capability. But also, as a second part, is the suitability function that comes out of this. And by this is what we mean is making sure that suitable products are being provisioned or brought to you as an investor, but also on the portfolio level, and it's more sophisticated, that the portfolio mix actually is evaluated for suitability, right? And then the actions thereof. So that's the second part. And then as a last, I would say, and that's really coming up very new, is this whole portfolio advisory next best action. Of course, also be driven with the AI dynamic that we see in the market. I'm not really immediately talking about an RM co-pilot, but that's also coming up. Efficiency of relationship managers putting together a proposal based on the individual's context. So that lends itself nicely for, let's say, a Gen AI use case. And we're, of course, investing into this area as well. But also the next best action, we have our wealth cockpit. So that has such components that allow basically, even down to affluent segment customers to receive actually an investment recommendation based on, I call it non-traditional or segment clustering. What this means is it's not just based on how much you have, AUM based, but much more of where you are in your life. What are some of the other very important attributes that currently the wealth industry is not scrutinizing as much? On the relationship manager front, yes, because they know you as a person. But let's say from a data model point of view, it's much less explored. Things like can go down to religion even, culture, but of course much more towards your profession, and of course hobbies, etc.
Yeah, I love that. I mean, I saw it recently with one of the virtual banks that wants to go also more into wealth, and we will have a dedicated podcast session on that topic. But just to round it off, on a Sunday, I quickly booked my trip to Switzerland. I'm 2-3 times a year as a Swiss national in Switzerland. Book usually through the same platform. Ordered basically a Tesla for driving around Switzerland and seeing the mountains. And it's a small example where the bank then called me up, a virtual bank calling me instead of chatting with me or sending me a message. Was already a bit strange. But instead of calling me and using this as an opportunity and saying, hey, according to the data here, you're going frequently to Switzerland, there are also, I don't know, a certain investment into a Swiss market, properties or something that would you be keen and interested in? No, they check with me if the transaction is valid, even though it's a transaction I do very common and frequently, and they bother me on a Sunday with just such a check. It's probably for a next podcast, as we are already on time, but I would love to see also, especially the virtual bank that are already on cloud, already microservices enabled, and have everything that empowers you to do wealth as a service in the future, that they would make that step. I'm sure you're already talking to some of them, and I'm interested to hear then in the news what comes and follows accordingly.
Yes, we don't like to be called on a Sunday for an AML check. I fully agree, yes.
Exactly. Good. With this, thank you so much, Yves, for the conversation today. Of course, as I said before, there is much more that I would love to ask you. There is so many other questions that come up. With this, I will also, of course, encourage our audience to come back to us, ask questions if they have. They will find us on social media, YouTube, LinkedIn, and so on with the Pulse Check podcast. And of course, hopefully they also follow you on social media and will see the latest insights in wealth as a service. So thank you, Yves Roesti.
Thank you, Salomon. Great platform and great to be here.